All right, a couple thoughts about when to trade, when not to trade. If there's 52 weeks in a year, there are 200 and you can call it 260 trading days. But when you take out holidays and the Fridays before Thanksgiving, the Mondays after Memorial or Tuesdays after Memorial Day, which tend to extend the activity and the volatility and the tradability of markets, you really get down to about 200 days. So take away about 50 days. And then when you take away the 200, and when you take a look at the 200 days, you're really going to have 50 or 1 day a week. That is just a great opportunity. And when you get that 1 day, you need to know the context and know how to behave, and that's really something we want you to focus on when you come to work at the Market Profile Trading Academy. Is although you're sitting trading weekly, daily, throughout the day, there are opportunities, time that are more beneficial for you than, say, a late Friday afternoon on an August, or an early Monday morning on an August, or the Friday before Christmas on Monday or Tuesday, or the Wednesday, really the whole Thanksgiving week. You might as well just take off and come back post-Thanksgiving when people are all full of turkey and dressing and ready to go back to work. So when to trade, when not to trade is important from a macro perspective. Do you need to do it every day? Not really. And there's really, let's say again, 50 great days. So 20% of the days are going to make you 80 to 90% of your money. That doesn't mean you're not in the trade for all those days. You may be in the trade, but for it to come in and pay you when it's going up in your long, or when you're short and it's coming down, those days that you get paid maybe happen 50 days a year if you're not scalping. And I don't scalp, and I don't believe that is the easiest game out there. There are people that do it. I don't do it well. I don't want to lose as many times as they need to. I lose, but I lose less often because I don't scalp. The other thing that you need to consider is the time of day. Kind of that 9 to 11 again is not a good time to trade. Get away from the markets, just like I'm doing this recording right now. It's a gorgeous spring day here in Bend, Oregon. The birds are out. I'm sitting here over the river watching people walk by on the path. I'd already did my walk, and I'm just taking a break before going back to the screens for the afternoon session. So know when to trade. The opening half hour, the opening hour are key as far as context, what's moving, what isn't, and then the closing hour. Within both those, though, you have a lot of games. You have a lot of positioning because you have so many day traders that need to get in or out by the close. And I don't base my trades. As a matter of fact, a lot of times I'll use those opens and closes to make my position even better. If I'm long and they're taking it down just because they need to get out by the end of the day, I'm going to buy some more. And you can tell, and these are the types of things that using the profile will assist you in making better decisions and when to be into the market and when to be out. So just wanted to talk about that timing. We spend a lot of time on time, risk, and hope you have a great day. We'll be back here with more video segments at the Market Profile Trading Academy. Peace.